Hello and welcome. Today we're going to be interviewing a very interesting company which has a thumbs up on every metric that we rate our companies on. And we're going to be speaking with the management of Affle 3i. It's a unique company, one, because the business model is extremely unique. It's into performance advertising and therefore makes its revenue only when there is an ad spend which has, or rather an advertisement which is actually converted into revenue for the customer. That's the one very, very unique way in which Affle's business model is structured. And the third piece which is interesting is that the AI landscape and how that is changing and impacting Affle, because the stock price per se is down 17% over the last 12 months. It has in fact rebounded nearly 25% from the lows of March of this year, and therefore plenty of choppiness on the stock price, but at that point of time was at its one of its lowest price to earnings ever, where Affle was available. And therefore we've tried to kind of dissect this one, and despite the 25% run up, you're still well away from that 52-week high on the stock price. So we'll see how this plays out in terms of the business itself, as we always do. Take a bit of a step back. It's India's largest listed ad tech company. What it essentially does is performance advertising. I described it in a very small fashion, and it's powered, of course, with AI technology. It formerly was called Affle India, promoted by Affle Holdings, and it has the likes of Microsoft and BCCL as investors within Affle. Now, let me talk a little bit about the story. You've got, every app typically spends money to get itself installed onto your phones. Most advertising is wasted because clicks don't convert to action and revenue. But Affle has flipped this model. What Affle has said is it will get paid only and only when a real user does something real, which is it does a real spend on the app. So it installs, registers, purchases, transacts, or visits the store. There can be, based on what the customer, which is Affle's customer, requires, which is the fintech or the product company, which is actually advertising, basis what they require, Affle does this. There's no conversion. If there's no conversion, there's no payment made to Affle. The conversion is, of course, the key positive which Affle will look for, and only then will the revenue come in. And 99% of the revenue comes under this model. This is extremely powerful. It's called the CPCU, or the cost per converted user. What this does is that the advertiser actually pays only for guaranteed outcomes, not impressions. And the outcomes are decided by the advertiser himself. This makes revenue very, very sticky even in downturns. It doesn't matter if there is a downturn, because the revenue, the advertising spend and Affle's revenue is linked to the revenue of its customer. So if when you have an advertising linked to revenue, or an advertising spend linked to revenue, it'll be probably the last item which an advertiser or the customer of Affle will look to cut down, even in case of a downturn. Spending generally stays and holds up, and budgets generally don't get reduced. In fact, may actually pick up during downturns, because what will likely happen is that because of the downturn, the customer actually wants better conversion, and Affle gets paid based on conversions. That's how you would typically want to think of this. So the entire revenue formula is the number of conversions multiplied by the average CPCU rate, which is the cost per converted user. Essentially, the number of conversions have gone up over the last few years, and I'll talk a little bit about that. And also the price per conversion has gone up. So on both sides of the lever, Affle has actually benefited, and there's been a tailwind. We'll talk about numbers in just a bit. Now, let's talk a little bit more about the business model before I talk numbers. To get paid only on conversions, Affle must ensure two things, right? Typically, just logically speaking. One, you've got to find the right consumer, or the right, the right person who will purchase the product. That is one. And this is done through AI targeting. There's a proprietary consumer intelligence platform that they have. Real-time predictive algorithms match the ad to the likely converter, and around 4 billion devices are actually connected devices which Affle is able to reach to. In terms of the other key challenge, one is this, the other one is to filter real humans versus bots, because bots will not really convert into a spend, into consumption, whereas Affle's revenues are linked to consumption and spend, and therefore digital advertising is plagued by these fraudulent bot-driven fake installs. If Affle paid for fake conversions, it would actually bleed money. And patented human versus non-human filtration is where the hidden moat also lies, where Affle is concerned. There are 39 unique patents that they have, 18 are granted, around 300 enforceable claims that they hold on the back of these two unique pieces within the Affle platform. When you're looking at the platform stack, you'll see various products all over, which are all connected. There's AppNext, which is an OEM and on-device app discovery. There's Jamp, which is programmatic user acquisition and retargeting platform. There's Mass, which is mobile marketing platform. MediaSmart, which is connected TV and audio advertising. There's RevX, which is again programmatic retargeting of customers. There's Visuri, and there's UAppy. And all of these come together into one ecosystem, which Affle essentially sells to its customers. The customer verticals are broadly divided into 4 verticals. One is e-commerce, very simple, right? D2C and the like. Then there's fintech, again a large one. Then the third one is gaming, and very easy to understand, because say for example you're playing a game, a free game on an app on your phone, you will likely start to see pop-ups of ads and the like, right? And therefore it's a very important vertical of for Affle. Then there's health tech, and then there you have various other customer verticals as well: retail, travel, OTT, connected television, telecom, hospitality, and the like, right? So you've got then a whole host. Why this matters? Because fintech conversion and gaming conversion are different, and therefore for every vertical you'll have a different sort of cohort or requirement or data sets to be analyzed, which Affle does internally through its AI and the like, and therefore there is a different design for each vertical, and therefore these verticals matter. Let's talk about the geographic split. 72% of the revenue comes from India and emerging markets, 28% from developed markets. US, Europe, developed Asia is where they typically target. The higher CPCU rates, right, in the developed markets. So as you get into developed markets, your margins get better. Let's talk about conversions now. I spoke about this, very important, two triggers. When you look at the conversions, Q1 FY25, Q1 FY26, Q1 FY27, you'll see how the conversions have gone up. These are converted users or converted customers for the customers of Affle, right? So consumers which have actually clicked and purchased, made a purchase, and that's what you're seeing on your screen. And then the average rate per conversion, and that drives revenue. So your average rate per conversion has also gone up, and your conversions have also gone up, and both of those have driven revenue higher. Let's talk about the P&L now, very quickly onto the numbers. The revenue has grown at 24%, EBITDA at 28%, net profit at 23%. So you've seen a very decent kind of a growth. Mind you, this is a 23,000 crore market cap company. Approximately 10 times sales is what this trades at, but it does a very healthy EBITDA margin of around 22%. Sometimes it falls to sub 20 in one quarter or two is what I have noticed, but otherwise on an annual basis they are able to hold the 20% on the margin number very, very well. That's how they're playing this. Let's talk a little bit about the balance sheet now, and you'll see a thumbs up across the board except when we get to valuations. Let's talk about the balance sheet. Around 3,652 crore is where the book value currently lies. You have almost no borrowing on the balance sheet, and then you have a cash bank balance of around 1,300 crore, plus you have investments as well, which is sitting in the balance sheet. So the balance sheet of 3,600 crore, or nearly half of that balance sheet, nearly half, is cash and investments which they have to ensure that they are able to make acquisitions in a timely fashion, integrate it into the Affle platform, and continue their journey upwards in terms of growth. Let's talk about cash flow. Healthy in terms of cash flow metrics, no worries at all. Of course, receivable and payable days are as per business standards, but the conversion of EBITDA to cash is visible here, and no worries per se. Let's talk about the ROCE numbers. Despite having such a high investment and cash pool in the balance sheet, your ROCE number still sits at roughly 17%, goes to as high as 28% in good cycles. So therefore, kind of shows you the resilience. Shareholding pattern, 55% is promoter shareholding, 15% is FIs, 19% is DIs, 11% is public at this point of time. Fairly solid across years, except that DI holding has gone up, as you can see on your screen, from FY24 to FY26, or rather June 2026. Let's talk about analyst recommendations. 16 buy calls, 1 hold call, no sell calls, 20% upside, thumbs up there as well. But let's now talk about valuations. You're looking at 39 times 1 year forward is what this one trades at, as per obviously average analyst estimates. The 5-year average is 49 times, so certainly it trades at a discount to the 5-year average. The 5-year range is between 31 and 88 times, so trades at nearly a 20-30% premium to the low. But we've seen that has happened sometime in March, and thereafter the stock has rallied. Broadly, that's how we're looking at it. Of course, there is some bit of growth that's been priced into the valuation. There's also some risks which we've spoken about from AI and otherwise. Let me bring on board Anuj Khanna Sohum. He's the chairperson, managing director, and CEO at Affle 3i. Great having you here, Anuj. It's been a while. Let me quickly start off with how Q1 has been for you. Your gross margins, Anuj, you've seen a bit of a squeeze on that. I understand that that's part of the strategy that you use, but give us some color. Have they bottomed? Do you now start to see a pickup in gross margins? How should one look at that number?
First of all, thank you for having me on your show. Q1 has been a fantastic result for our company, not just on financials, but also on the strategic competitive advantage that we have established. We bought the strategic assets of AdColony, including their technology stack, the SDK, as well as the brand, the trademark. And we are in a very strong position, stronger than ever before. And it's showing in our financial outcomes. Revenue has grown over 20%, but for almost 95% plus of the business, the revenue has actually grown 25% year on year. The margin expansion, if you look at it from a bottom line perspective, profit before tax growing over 22% year on year. That's growing faster than the revenue, which means that at an overall level, there has been margin expansion. In terms of the impact on conversions, you would see that we have achieved the highest conversions at the highest CPCU rate, over 60 rupees this time. And that's factoring in some of the macro factors, the macro headwinds with respect to currency changes and so on, but giving value enough to the advertisers while still seeing margin expansion on the bottom line. So that very sensible balance has been maintained in the Q1 execution.
No, point taken, Anuj. But give us a sense. This gross margin number, I understand that the numbers look very healthy. I'm trying to pick and choose and trying to understand where you could have levers for further margin expansion. And gross margins is one of those places, right, Anuj? Because your data costs have gone up by 24% YOY, your top line has grown by 20%. So you clearly have that as one of the levers which can unlock margins for you. Give us a sense as to what's playing out, what's the strategy, and when does that unlock happen?
So the answer lies in the fact that we are going deeper verticalization with the advertisers, giving them more premium conversions so that we can price it higher. We can charge them a higher CPCU rate going forward, which you can see the consistent trend is there, where we're charging higher by justifying more premium, better ROI for the advertisers, so we can charge them better. That's one. Secondly, with the vertical integration, where we're going deeper in connection with the publishers. So the acquisition of the AdColony SDK, on an organic basis, we believe in this year, in this calendar year itself, we'll be able to grow our footprint to over 100,000 apps where this SDK can be activated. We believe we will get to over 500 million connected devices focused on developed markets, which will again provide us an ability to deliver better value to our advertisers, charge a premium, and make healthier margins than what we have made in the past.
Point taken. And AdColony itself, if you can give viewers a little bit of perspective, what does it add to your current suite, and does it and how many users does it give you directly as part of this acquisition?
Thank you. So this has a long history. AdColony has been around for well over a decade, almost 2 decades in the industry, focused on developed markets, has a very strong goodwill and brand reputation. in terms of the technology and what they have done in this time. And in year 2020 to 2021, it was available for sale for us to even buy and bid at around 400 million US dollars for the entirety of the business. It was acquired for around that price by a US public listed company. And more recently, we found an opportunity where we can buy those strategic assets, the SDK, the technology stack, and the brand name from that public company that acquired them in 2021 for just around less than 5 million US dollars. We believe what we have got is a windfall strategic gain, the brand, the connection with the ecosystem on the publishers directly, and our ability to organically now activate over 100,000 apps, over 500 million connected devices focused on developed markets is an absolute competitive advantage that we will unlock during the course of this year with the AdColony acquisition.
And what caused this windfall? I mean, there has to be a catch to it, right? Anuj, what played out over the last 5 years that the value depreciated by that much?
So the company that acquired AdColony also acquired another company in the same space. They merged the technology stacks and so on, and they had reason to take AdColony out and spin it off for sale, because they essentially in their consolidation and merger they focused on the other stack that they had bought, and they couldn't run two in parallel, so they decided to only run one, and therefore AdColony became more available to us.
And strategic inventory, Anuj, how much time is that taking to convert or to turn profitable, if I can ask you that? And has that at all changed maybe versus maybe 1 year or 18 months ago? I'm asking you this from a perspective, and you can correct me if my understanding is wrong, whether the landscape is changing with regard to how strategic inventory is carried, built, as well as acquired, if that's the right way to kind of think of it.
No, so the way to think about it is that Affle is a consumer platform. We are a consumer centric platform, and we are focused on all the connected devices that this consumer in their normal internet journey goes through, where the mobile device is the most valuable one because it is the most private, personally carried device. Next to that is CTV, which is smart TVs in most of the households, increasingly having smart TVs. That's again a very important connected device, and any other what we define forward-looking basis as autonomous, agentic, intelligent connected devices. Now, these could be in malls, these could be in pharmacies, these could be more autonomous vehicles, as we go along from wearables all the way to autonomous vehicles and robotic devices that may come in the consumer's journey. All of these connected devices are where we are finding touch points where we can show ads, create engagement experience with consumers. The same consumer can drive a conversion for us from a mobile device, from a CTV, or any other AICDs as we define it. So therefore, when you look at inventory and you see it as which inventory is more profitable, our language of dealing with inventory is very different. We are saying whichever connected devices the consumer is spending time and attention on, that's where we will place a premium. That's where we will make a purchase decision based on our algorithms to drive maximum number of conversions for minimum amount of advertising, right? So we want to have least amount of advertising to get maximum value and volume of conversions. So therefore, we are not necessarily in buying inventory or holding it. We buy inventory in real time in those places where we believe we have the highest probability of driving consumer conversions.
But you still hold strategic inventory, right? I mean, that's part of the business model, if I've understood this right.
So we never hold inventory. Okay. So in we buy it in real time. So it's almost a programmatic algorithm. So let's say if you go on your device now and you start, playing a particular game, or you start, let's say, using a particular app, a fintech app or a game. And in that moment of truth, our technology would decide whether we want to show an ad to this connected user on this connected device in that particular instant. It's a decision made within split seconds. Now, if we have our SDK on that app or a device, that can give us some deeper insights and competitive advantage. But in terms of whether we will buy and pay for that impression or not, it's decided in real time.
Point taken. Anuj, I wonder if the average conversion rate, which has been going up quite steadily, is that going to be a larger lever that you use going forward? Because obviously the conversions are what you are currently completely relying on, or to a large extent relying on, for the 20% plus growth that you're guiding for. I'm trying to understand whether this becomes a lever at all at some point of time.
Absolutely. So what we're seeing is a steady increase in the number of online conversions that the consumers are making. The volume of conversions is going up across geographies, emerging markets and developed markets. The average value of the conversions is also going up. The consumers are becoming more and more comfortable transacting on mobile devices, and therefore digital conversion volumes are going, the value is going up, and therefore we are very bullish that supporting 20% consistent long-term organic growth is something that we are deeply convinced about, and we are seeing ongoing momentum that is confirming that our conviction is well placed and it's backed with data.
And on the acquisitions you make, sometimes they are margin dilutive, at least to start off. How long do you typically take for margins to come back, and will margins therefore hold 20% no matter what acquisition you make? I'm just thinking strategically, how do you identify it? How do you zero down? Is there a threshold below which you don't go?
So if you look at our track record, we have consistently shown that in terms of doing strategic M&A, Affle has a flawless track record in terms of turning each of those acquired entities around to deliver over 20% bottom line margin performance over these years. The most impressive one was the last acquisition that we did, which was UAP, over 3 years ago. But within the first year itself, we turned them around to the highest level of performance in terms of bottom line margin contribution, to be around 20% plus in terms of margin within the first year of the acquisition itself. And since that time, I've been pretty vocal and clear that going forward, we will only do those acquisitions where, in terms of organic growth momentum, we will not get slowed down. We should have the kind of velocity of 20% organic year-on-year growth on a combined basis after that acquisition and integration is done, as well as ensuring that the bottom line performance can get to a 20% EBITDA margin performance within the first year of the acquisition. So those are the stated goals, and we will see how we deliver on that.
Anuj, promoter has infused money. You already sit on a large cash pile. You've made acquisitions on a recurring basis, but promoter has infused some more money. Give us the rationale for that, for requiring that additional step up. And I believe there's a pledge at play as well.
Well, at the moment, I would say that the kind of acquisitions that we have narrowed down, and we've been very transparent about it with all our stakeholders, in terms of number of companies we have evaluated, where all have we done preliminary due diligence, and now we have reached a stage where we have appointed third-party advisors to do deeper due diligence on the target that we are actively evaluating. Now, the size of the transactions are such that we need to have the right kind of financial muscle power to see it through, and therefore we have raised the appropriate amount of funding, and we have given the right kind of disclosures on how the utilization would happen and over what period of time. So I think the goal is to close at least the one large significant M&A transaction by early 2027. And I think we are well on track for that.
AI is not disrupting you in a big fashion. Just 30 seconds, very quickly, Anuj, I need to close this.
AI is providing us clear tailwinds in our business, and not only for our business. I think AdTech in general will see AI as a tailwind, as a positive factor for many years to come.
All right. Thank you so much, Anuj, for coming in and speaking to us. Completely timed out on this edition of All About Your Company. Viewers, thank you so much for tuning in. 20% plus growth, looking very, very comfortable, at least the way Anuj is guiding. And at least the numbers in Q1 seem to support that. Completely timed out. Thanks so much for tuning in.